You mentioned there's something like 1 million central bank meetings this week. If we boil it down to just three, we have the Fed, we have the Bank of England, we have the Bank of Japan. Which bank has the potential to surprise markets the most here?
That's a really tough question. I think the Fed, basically the market is priced that nothing's happening, and the Fed historically does not disappoint the market positively or negatively. So I think that's unlikely. The BOE, the market is expecting the Bank of England to hike. Interestingly, in the last month or two, the expectations for the terminal rate or the peak rate in the UK has gone from 6.25%, 6.5% down to 5.25%, 5.5%. So there's been a big shift downward in terms of being less hawkish. I think there's room for surprise there in terms of the BOE and what they might say about expectations. I would have said the Bank of Japan.
Yeah.
But on the 9th, I mean, basically, Governor of Bank of Japan, Ueda-san, had an interview where he talked about maybe by the end of the year we'll have the data we need to decide if we should think about going out of negative rates. That was the big surprise. So I think he kind of front-running himself in terms of the media headlines. So that's a long way to say I'm not sure, but maybe the Bank of Japan, if we get a reiteration from Ueda that the Bank of Japan thinks that they've won the battle against deflation, I think that would be a pretty significant surprise.
Yeah, that would be a huge structural shift, I think, at least for that part of the world, and I guess foreign investors invested there. I am curious here, Ron, about kind of how investors should sort of interpret where we are in this rate hiking cycle. If you do believe that they are done, then you must believe that market rates are either at or near their peak. So what does that mean in terms of the next decision that you make about what to buy or sell?
Yeah, I mean, honestly, this is the first time since the rate hike cycle began that I think the market is finally pricing things appropriately, meaning we've been too dovish for too long. When the market would finally get the peak rate, the terminal rate right, it would assume that the Fed would immediately turn on a dime and start cutting rates. And so if you look back, it was only a couple of months ago, 2-3 months ago, the market was saying Fed funds would be back at 4% by March of next year. Now it's saying we're basically not going to see a cut until the second half. So when I look at the markets, I think number one is if you're thinking about allocations to fixed income, it's looking pretty attractive. I think extending duration, locking in some of these higher rates might make good sense right now. I do worry that the equity market still doesn't seem to be pricing this in fully. And again, I have to be careful there because the equity market includes very different situations. Yeah. The equally weighted S&P is at 15.2 times earnings. The S&P is at 19.2. So this, to me, is an argument where if you've been passive and you've really enjoyed this ride up in equities, maybe now is a good time to rethink that and allocate to some of the parts of the market that have not worked.